Welcome to the deep dive. Today we're digging into a market that's seen, well, a lot of changes lately. Austin real estate, you've shared some really detailed sources, a market trends report, a daily briefing, and our goal here is to, pull out the key insights. We want to understand what's really happening, how that buyer-seller power dynamic is shifting, and maybe peek into the future of home prices there.
Absolutely. And what's really striking is how the numbers, when you put them together, they paint this pretty clear picture of a market in correction. We'll connect those dots, look beyond just the headlines, and see what it means for, well, anyone paying attention to Austin.
Okay, so let's start there with this correction. The first thing that jumps out is just the sheer number of homes available. It sounds like inventory is swelling quite a bit.
It really is. We're seeing near record levels. So on July 4th, 2025, the number of active residential listings was 17,751.
Wow, 17,751.
Yeah, and that's only about 325 short of the all-time high, which was just the week before, actually June 27th, at 18,076 listings.
Okay, that's huge. How does that stack up against, say, last year? Is this typical seasonality or something bigger?
Well, it's much bigger than seasonal changes. That 17,751 figure, it represents a 14.5% jump compared to the peak inventory we saw in July 2024, which was around 15,500. So yeah, significant increase. And it's not just one neighborhood, it's really across the board, most of the metro area and the surrounding cities too.
Right, so inventory is piling up. But that's only half the story, isn't it? What happens after these homes are listed? You mentioned price adjustments.
Exactly. And this is where it gets particularly telling for sellers and maybe interesting for buyers. Right now, 57.1%. So well over half of all active listings have had at least one price drop.
Over half. Wow.
Yes. It strongly suggests sellers are having to compete much harder. Asking prices seem to be, a bit out of sync with what buyers are currently willing or able to pay.
Is that pressure uniform? Are some places seeing more price cuts than others?
It's definitely widespread, but yeah, some areas are feeling it more. If you look at the city level data, places like Lago Vista, Georgetown, Round Rock, they're reporting price reduction rates over 60%. But even in traditionally strong areas like Austin proper or Cedar Park, you're still seeing more than half the listings getting price cuts. It really shows how pervasive this shift is.
Okay, so more homes, more price cuts. What does this mean for the other side of the equation, the buyers? Is demand keeping up? The report mentioned an activity index.
Right, the activity index. It's basically a way to measure buyer engagement relative to all that inventory we just talked about. And it's down. It's currently sitting at 19.2%. Now, compare that to 22.9% this time last year. That's a 16% drop. It reflects waning buyer urgency, less transactional buzz.
16% drop in activity. Okay. And how does that feed into the months of inventory number? What does that tell us?
Well, it feeds directly into it. The months of inventory, or MOI, is now at 6.31 months. That's up sharply, 18.3% year over year.
6.31 months. What's the significance of that number? Where does that put Austin?
So generally, a balanced market is considered somewhere between 5 and, say, 6.9 months of inventory. Anything over 7 months, and you're firmly in a buyer's market. Austin, at 6.31, is technically in neutral territory, but it's definitely trending towards favoring buyers. And, in many of the surrounding cities, the MOI is already over 7 months. Places like Marble Falls, Dale, Spicewood, they're reporting double-digit months of inventory. That means, for buyers, more choice, more room to negotiate, and likely longer waits for sellers.
Okay, got it. There's another metric mentioned, the new listing to pending ratio. What light does that shed on things?
Yeah, that ratio compares the homes just coming onto the market, the new listings, to the ones actually going under contract or pending. A ratio of 1.0 would suggest balance one home sells for everyone listed. Austin's current monthly ratio is just 0.67. The year-to-date figure is also 0.67.
0.67, so way below that balance 1.0 mark.
Exactly. It's also significantly below the 25-year historical average for Austin, which is 0.81. Simply put, it means for every 100 new homes listed, only about 67 are going under contract. This persistent gap shows weaker buyer demand compared to the supply coming online. And that, contributes directly to the rising active listings we saw, the price cuts, and homes sitting longer. Just to put a number on it, the cumulative difference, the gap between new listings and pending sales, is over 6,600 homes so far in 2025 alone.
Wow, okay. So inventory's up, activity's down, the ratios look weak. What about the bottom line actual sales? Are fewer homes actually changing hands?
Yeah, the sales volume is definitely feeling the strain. If you look at year-to-date sales, we're at 15,009 properties sold. That's down 6% compared to this point last year. Now, that number is still about 8.6% above the long-term average, but there's a big caveat there.
Okay, what's the catch?
The catch is Austin's massive population growth over the last decade or so. A lot of that above average number is simply due to there being more people, not necessarily because the market per person is strong right now.
Ah, right. So if you adjust for that population boom, what does the picture look like then?
It looks quite different, significantly weaker, actually. When you adjust for population, the cumulative sales per 100,000 residents comes out to 589. That's down 8.3% year over year, and it's nearly 20% below the long-term population-adjusted average.
20% below average per capita. That really highlights a slowdown.
It does. It shows that relative to the number of people living there, fewer transactions are happening. It's a clearer sign of weakening market activity.
And the million-dollar question, or maybe the $445,000 question now, what about the prices people are actually paying? How far have they fallen from the peak?
This is probably the most direct indicator of the correction. The median sold price in the Austin area is now $445,000.
Okay, it's 45.
Yeah. And remember the peak. Back in May 2022, the median hit $550,000. So that's a drop of about $105,000 or a 19.09% decline from the peak.
Ouch. $105,000 off the median price.
It's significant, and the average sold price shows a similar story. It's currently $587,332, down from a peak of roughly $682,000. That's about a $95,000 drop, or nearly 14% down.
Is this price drop hitting all segments of the market equally? Or are, say, luxury homes holding up better than entry level?
It's not hitting equally, no. We're seeing what's called price compression, and it's most pronounced at the lower end, the bottom quartile of the market. Those homes have seen their median prices fall by 5.71% just in the last year. So the steepest percentage drops are actually happening in the more affordable segment.
Interesting. And the higher end?
The top 25th percentile, the luxury end, has been relatively flat. The median price is actually up slightly, 0.39% year over year, but the price per square foot is down just a tiny bit, 0.18%. So it suggests that higher end inventory is holding its value better, relatively speaking, but it's certainly not immune to the overall downward pressure. Still softening.
Okay, so with prices down nearly 20% from the peak, median-wise,
Okay.
the big question for anyone who owns or is thinking of selling is, how long might this recovery take? When could we see prices back at those May 2022 levels?
That's obviously tough to predict with certainty, but we can look at historical trends for some perspective. The long-term 25-year compound appreciation rate for Austin real estate is 4.934% per year.
Okay, just under 5% annual appreciation historically.
Right. So if we make an assumption, and it is an assumption, that the current median price of $445,000 is the bottom of this cycle.
A big if, but let's run with it.
If we use that historical appreciation rate of 4.934%, well, the math suggests it would take approximately 55 months to get back to that previous peak median of around $550,000.
55 months, that's what, over 4.5 years? So potentially until late 2029.
Exactly. Roughly December 2029, based on that calculation. It really highlights that real estate corrections, especially after such a sharp run-up, tend to have long recovery periods.
That's a very sobering projection. It definitely pours cold water on hopes for a quick V-shaped recovery.
It does, and it serves as a cautionary note. Sellers probably shouldn't expect a rapid rebound. Of course, things could change. Faster economic growth, significant drops in interest rates could speed things up. But equally, continued oversupply or other economic issues could slow it down even further. The data points to years, not months.
Understood. The sources also mentioned a couple of other indices, a market health index and an inventory stress index.
Yeah.
What do those tell us? Do they sort of confirm this picture?
They absolutely do. They reinforce this idea of market imbalance. The Market Health Index, or MHI, which is like an overall checkup on market strength, is at 17.60%. Historically, the average is around 30.90%. A score below 30% generally points towards a buyer's market. So 17.60% really underlines the leverage buyers have right now.
Okay, and the inventory stress index?
The ISI measures excess supply relative to how quickly homes are selling, essentially market absorption. It's currently at 5.02%. The historical average is much higher, 12.56%. A low score, anything under 10%, also points to conditions favoring buyers. It just shows how much that supply is currently outweighing the demand.
So, putting it all together, this deep dive really paints a consistent picture, doesn't it? We've got high inventory, lots of price cuts, slower buyer activity, falling sales per capita, significant price drops from the peak.
Precisely. It's a market clearly in a correction phase. The data strongly suggests that any recovery back to those peak prices, if and when it happens, is likely a multi-year process.
Which means sellers really need to adjust their expectations.
Absolutely. And buyers need to recognize the window of opportunity. This presents more choice, more negotiation power. It's a different landscape than just a couple of years ago.
Definitely. So for you, the learner listening in, whether you're thinking about buying, selling, or just watching the Austin market, here's something to chew on. Thinking about that potential long recovery timeline, maybe out to 2029 or beyond, how might that influence not just individual decisions, but maybe the broader economic path for Austin? Things like development, investment. It's certainly a lot to consider.